what's up, everybody? Kenny Simpson here at the Simpson team. So today I just wanted to make a quick video. There is a lot of stuff going on, but some of the things you might be hearing in the news is inflation, rates rising, Feds raising rates, Feds are going crazy. And so today, this video, I really wanted to talk about inflation, what I'm hearing, what I'm seeing with all the, investigation, reading, listening to podcasts, interviews, all that. I spend a lot of time in the macro world, listening to hedge fund managers, real estate people, all that. And obviously with the podcast, we're able to talk to a lot of people too around the country in real estate. And so I also wanted to talk about what's going on with the Fed, their latest update, what that might mean for us as kind of like the economy, what that means for housing, what that's going to mean for rates. So first of all, inflation. If you didn't know what inflation is, I'm pretty sure you know what it is now. And I'm just going to make this statement as I tell everybody. Nobody really knows what the price of gas, food, interest rates, housing. We really don't know what the price should be. Obviously, with housing, there's a supply-demand issue. It's very clear that if you're in a certain state and there should be 10,000 listings, in a city where you live, and there's 2,000, we clearly have a problem. Even with rising interest rates, that does not mean it's going to cure or fix anything. So what I really want to talk about the inflation is more of the cost of gas, the cost of a steak, the cost of supplies, all this. Here in California, do we really know if gas should be $6? Do we really know if that steak at the restaurant should be $80 when it was $40? So we really don't know. And unfortunately, the only way to tell what the cost really should be is you have to have a reset, because it seems like there's a lot of price gouging going on. A lot of people are probably taking advantage of us and we don't know it. And that's why I said should gasoline, when I drive out right here today and I go pay $6, $6.50, is that really the cost of gas, or are we just getting gouged? So unfortunately, Jerome Powell, the Feds, about a year ago this time, they were preaching on their soapbox that they're not worried about inflation. It's transitory. That means it's temporary. It's going to go away. They kept pumping money in the system. They kept sending money out. And when you guys got to understand, when they're pumping money, when they're buying mortgage-backed securities and they're keeping rates low, that is money into the system. When rates are low, people are borrowing money. They're pulling from their house. They're pulling from business line of credit. These big corporations are pulling money. People are refinancing stuff, taking cash out of properties. There's a lot of things going on. That money gets pushed back into the economy, whether they're buying goods, services, hiring people, cars, fuel, food, whatever it is, it goes back in the economy, and that obviously pushes things up, which is great, but that went on too long. And so I heard somebody say the other day that the Feds left the punch bowl out at the party way too long, and then they spiked it, and now we have to deal with it. So today, as I shoot this video, beginning of April 2022, the message is completely different from the Fed. The message is basically what they don't want to tell you, which way they wish they could just come out and tell you, is we f***ed up. We really, really screwed up. We went way too long, way too far, even though there were super, super smart people that I listened to on a daily, weekly basis that literally called them, sat in front of them last year and said, slow down. You're going to cause a problem. And so that's why I kept preaching to everybody, 2021, 2020. Besides COVID, those were the easy years. Why? We were being bailed out. You didn't have to make your mortgage payment. You didn't have to pay your rent payment. You didn't have to make your car payment. You didn't have to pay your student loan payment. You still have to make your student loan payment. You could have just screwed your landlord on your rent. If you weren't working, you got bailed out and got paid even more. Then they gave you more money and more money. And so we basically just kind of screwed ourselves. So here we are, 2022, as we ended 2021, the conventional rate mortgage for me was about 2.875, let's just call it. Today, as I sit here, April, whatever it is, 5th, 6th, 7th, and shoot this video, the same scenario with the same rate is probably about 4.625, 4.75. The average rate is probably with the 5 in front of it. So you guys can do the math that interest rates literally have gone up over 2%. The cost of housing has gone up just with rates. The cost of housing has gone up because it's that much more expensive to buy a home. The demand is still here. Even at these interest rates at the 5% and on investment properties that are almost in the 6s, at the non-QM rates, that people, the bank statements and all this that used to be in the high 3s or low 4s, those are in the 6s too. Some of the interest rates on products have gone up as much as 3%. So do we really know what's going to go on housing? We don't know yet. But what we do know about housing, so let's talk about that for a minute. We know that housing is, there's no inventory. 70% of people are locked in, that have a loan, are locked in at 4% or less. Those people are not motivated to go out and buy and sell their house and buy another home with a higher interest rate. They're not motivated to go out and buy a more expensive home where their tax basis is going to be higher. And they're also not interested in trying to sell a house and buy another house in this crazy market where they might not be able to find anything, and they're going to land up in a hotel or a VRBO, or having to go rent a house or apartment that's even tough for a period of time. Nobody wants to do that, but people are actually doing that. Clients I work with sell, and sometimes things don't go right, and they have to go do VRBO, 11 hotels, put their stuff in storage, no joke. So this market of housing is not healthy. Before, everybody wants to fall back to 2007-8 with the crashes. So let's just talk about that real quick. If you watch my monthly webinar updates, we give great data. Monty over here puts it all together. Shoot, she knows it really, really well. So I'm going to repeat, and I'm going to give you the same little statistics that I give everybody I talk to, probably on a daily, weekly basis, whether you're a referral partner I work with, whether you're a client, whether you're somebody I know, insurance, whoever you are, title escrow I'm talking to, this is what I'm telling everybody. Let's get down to the data, because this is what matters currently right now. 2008, whenever right for the crashes, whenever the time was, there's 4 million houses listed on the market in the United States. Today, there's about 750,000 if we're lucky. Okay, so do the math. The profile of the borrower on a scale of 100 to 1,000. So if you're at 1,000, that is a bad number to be at, like a bad profile, like bad credit, stated income. The profile of the borrower before that time was about 900. The profile of the borrower today is about 100. We're talking an 80% decline. That the borrower is that much better. The average FICO score is probably in the mid 600s. Now it's in the mid 700s. People right before the crash happened, 30% of people were already underwater. When COVID hit, 3% of people were underwater. Housing has only gone up. The banks learned from last foreclosure crisis with the short sales. They don't want to do that. That's why you saw the forgiveness. That's why you saw the forbearance. Yes, the government went to them and put pressure, but remember, if we screw somebody's credit up, we take them out of the economy as a consumer. 70% of the economy is consuming. All of us buying goods, gas, food, cars, whatever it is, that is consuming. If you knock somebody's credit off, they can't buy a house, they can't buy a car, they can't get a credit card, they're not going to be consuming as much as they can. So we're learning these lessons as we go along. One of the other crazy statistics is in 2012, I'm just using that year because that's the data in my head, the average sale was 35% of the sales at that time were from short sales and foreclosures. January 2022, it was 1%. So as I sit here today and everybody's worried about a housing crash, don't get me wrong. Housing is definitely expensive. Rates have definitely gone up. That 30-year fixed mortgage, whatever the scenario is, the $500,000, $600,000, that payment's probably gone up $800 from where you could have been at, just 4 or 5 months ago. Okay, so that reality, you're pre-approved for $1 million home. Maybe now it's $900,000 because of the rates. Maybe you're going to sit on the sidelines. But let's talk about housing and finalize my little thought on that. Is that if rates keep going up and up and up, yes, demand should come down. But remember, is supply going to go up? Take a place like San Diego. Where are we going to get supply? Are people really going to sell? Because they have to have a place to go. If you sell a home, unless you're going to go rent a Reno-Vega and drive around the country, you need a house to go into. So until further notice, we're not seeing much correction and stuff in the market. I talk to people all over the country. Nobody's really seeing anything. And don't get me wrong, we might see more time on the market with houses. So instead of So a house goes out to the market, and in 5 days, boom, it's snatched up. You got an offer. You might see stuff sit for longer, which would be healthier. We're at 750,000 homes. We really want to be about 2 million. That's just healthy. That's just that Kenny or Monty here, they want to go sell their house, and then they want to go buy another house. It's not going to be a stressed out, chaotic, crazy, overpriced, do all these crazy things to get it. It's going to be more normal. Like, I sell my house, I can go buy another house. Maybe I'm competing with a couple other people, not 30 people. So, and interest rates, let's go over those real quick. They have gone up the fastest ever, since I've been around in this business, literally so fast. The Fed is clearly trying to slow down this animal of inflation and everything. Is it working? It's not working so far. So basically, how do they slow it down? They jack interest rates, which makes the cost of everything go up, slow it down. If you slow down housing, you will slow down the rest of the stuff because it will psychologically spook people. It will spook the Wall Street, the market, and things will slow down. That is what they're trying to do. We are basically on a freight train where the wheels are falling off. They're throwing stuff in the front of it to try to slow it down, and it's still going. So we don't know if the rate hikes, the stop buying, they're lowering their balance sheet. What that means, they're buying mortgage-backed securities. So they're buying treasuries and mortgage-backed securities to keep low rates. They're supposed to basically take their foot off the gas and slam on the brakes and stop buying them, which should cause interest rates to go up. My prediction, and just so you guys know, everybody was pretty much wrong about rates. The people that have the most data, the smartest people, they predicted the max rate might be around 4% by the end of this year. We're already at 5, guys. We're in the second quarter, the first month of the second quarter. My prediction rates would probably hit somewhere, just for me, about 6%. I hate to say it, but they might get there. So for other lenders, they might be selling rates in 6.25. Do I think they will stay there forever? No. I don't think they'll make it there that long. I think once we start seeing rates climb and the Feds really pump things up to slow this down, there'll be enough people that are going to stop spending, stop consuming, and it will slowly start slowing down the economy, and we'll have a reset. I think what the reset is more of the commodities, is the gas, the food, and all these supplies and goods we need in our lives. We are going to figure out what exactly that should really be and what that number is, because we don't know right now if we're getting ripped off or we literally are just, this is what the new reality is. So in regards to housing, if you're locking in a refi now and you have to refi, cash out, and people go, who refis? People are refining. They're getting cash out. They're looking at different options. And if you're buying a house, is it a good time to buy? I mean, look, if you have money sitting in a bank account, if you had $1 million sitting in a bank account in 2019, we'll just go back to 2019, and you have $1 million today, does that money buy you more or less? That means the value of the dollar is going down. It's getting devalued, okay? So money in your bank account, the Feds can print more. They literally just go on their computer, type up, and how they get it out to the economy, they can get it out there and print more and give it out to us. It's almost like monopoly money, right? It seems so fake and unreal how they can just literally create money out of thin air and get it out there and put it in our hands. We literally physically saw this happen over the last 2 years. So a lot of people are freaking out. They're calling financial advisors. They're going on YouTube. They're going to read books. They're asking professionals, oh my gosh, there's inflation. What do I do? If you typed in Google, what should I do with inflation? I don't know what comes up, but I'm guessing one of the things is going to tell you, buy gold, buy silver, buy crypto, invest in the stock market. But one thing I'm going to tell you for sure is it's going to tell you housing is a good bet. With rents rising, inflation going up, even as rates climb, even as they climb, housing has still not slowed down. So we are not sure if housing is going to slow down because there's too many buyers and not enough sellers. Also, as rates climb and we hit a correction, which is called AKA recession, which we are going to have, we don't know what kind of recession is. Is it going to be deep and long? We don't know. Is it going to be just more commodity? Or, I think we're going to definitely see a slowdown in retail sales. We're going to see a slowdown in, restaurants and travel and things like that. Absolutely. I think this summer, when in the next few months, people that rack the card that are barely surviving, they're going to have to start getting face reality, and they're going to have to really cut back on spending, and we're going to start seeing this. It's already being started. There's already signs of it. There's already cracks. And guys, honestly, this is healthy. Where we're living in now is not healthy. We need to change. So, and wrapping this up, the question you should ask is, how is this affecting you and what can you do? Housing is great in an inflationary environment. Every macro, every person that I've listened to on interviews, which is hundreds and hundreds and hundreds and hundreds of interviews, literally, I would say, even if they do not invest in real estate, they all say that real estate is probably going to be one of the best performing assets through this time. The Feds also can only make rates go so high before they have a catastrophic event on their hands. What you guys might not know is that there's over $300 trillion of debt in this world. That debt currently is on very low rates. What you don't know is $60 trillion gets refinanced every single year. Every single year, $60 trillion has to get turned over. And a lot of that debt is on floating rates or short-term rates. So if interest rates are sky high and you have to come up in companies, schools, businesses, people, governments, keep going down the list, have to refinance this debt, and the rate went from 2 to goes to 6, the borrowing costs skyrocket. So if you're a corporation, that's like, we got to cut back somewhere. If you're a government, oh my gosh, we can't even raise the taxes enough. Taxing the rich doesn't work. If you're $1 trillion over, you can tax the rich. They just said we're going to tax the rich and do all this stuff. And over 10 years, we're going to $400 billion. $400 billion, folks, won't even cover the interest, the interest if the interest rate just doubled, not tripled. If we're at 500, it won't even cover it. That is not a solution. The solution is simple in this country. It's like, let's get back to having America made, build stuff here, create jobs, create inventory, create our own economy, quit buying it from somewhere else, bringing it in so we can save a buck and make somebody else money. We need to make ourselves money. But is that going to happen? I don't know. But what I'm seeing and hearing out there, let me give you a couple interesting things. One of the podcasts I follow is a bunch of VC guys. They're out of San Francisco, and they basically raise money and they invest in companies. They're also some of the bigger SPAC guys. If you don't know what SPAC is, look it up. SPAC. It's another way to go public. But what they're noticing is the people that had valuations at 100x or this X, let's say the company was at 40 billion, now the valuation's at 20 billion. So the valuations in VC has already dramatically dropped 50% or less. Also, when these guys are part of board meetings, listen to this. They're part of board meetings. And on those board meetings, they're talking about money and economics and all this stuff. We have to listen. They're talking instead of let's grow, let's develop, let's this. We got to start cutting cost. Our valuation's lower. Some people bought in. Some companies went into this company at $100 billion valuation, and now they're going to go raise money at $50 billion. So the company that bought at $100 billion, they're assed out. The restoration hardware, like it or not, CEO came out recently saying this recession is going to kill them. Even though they make expensive, crappy furniture, sorry, restoration hardware, you know you do. That's one of the other things. So I listen around me. I ask people when I go into shops and businesses, how's it going? What's up? What are you doing this? We were just at a broker meeting. I'm asking these young kids, how's this affecting your life? That's my question, my last question. How is this affecting your life? How much more money are you spending monthly? What have you cut back on? Think about that. Where's your income bracket at? And go, man, I cut back and I still am okay. I have money in the bank. I have a 401k. I own my house. I still can live. There's people that don't have money in the bank. They don't own a house. They're barely surviving in 2019 when things cost 40% less. They are dying now. They're swiping a card. They're going into debt to survive. This is unsustainable. So, to wrap this whole thing up, we really have to watch the Fed. What are they going to do? And they clearly just made a statement. They said, we are going to do whatever we have to do to slow this train down. So nobody knows what that is. But let me tell you one thing about the Fed that you might not know. The Fed actually strategically says things because they're hoping that everybody starts listening and saying, guys, I'm kind of giving you this warning flag that if we don't cure this, so if you're a company, if you're at the big level, at the small level, how can we stop these crazy prices? Can gas get cheaper? Can food get cheaper? Can supplies get cheaper? Are you at the tail end of this raping us? Because if you are, and you don't start helping the problem, I'm going to have to slam on the brake, and I'm going to cause economic mayhem because of you're being greedy. They're telling us this. Literally, that is what they're doing. So the Fed also says these things because recessions, a lot of them are developed by just psychologically. We psychologically actually go into a recession before we go into a recession. So literally right now, many people are already psychologically cutting back. They're going into recession because they have to prepare for what might come. So I'm going to leave you with a couple important tips. Number one, the information you listen to about news, inflation, and rates and things, make sure you're listening to people that study data and not people that look at a, whatever you call it, in a prompter and read from it that don't know anything, okay? Number one. Your local news and all that stuff, probably not a good source. There's great podcasts. There's great things on, YouTube. Go find good sources that study data that deliver it to you. I would definitely start paying attention and seeing if you see prices drop, if you're seeing cracks in the economy. When you go into a restaurant, how's business? Slower, better? Oh, it's slower? Start paying attention, because if we do come up to a recession, what are things you can do? Make sure that you have extra cash in the bank, right? Make sure you're there. If you have some bad debt or things like that, and you're overloaded with credit card debt and you have equity in your house, even you're locked in a low rate and you're like, this is drowning me, it might be a time, to do a cash out refi, consolidate the debt, pay a higher payment, but overall, you're paying $1,000 less in payment. Like, get yourself in a position in case we come in through some tough times to get through it, right? The other thing is just look at your budget. Where can you go back to your bank statements and cut costs on stupid things you're spending money on that you don't need, right? These are the things we all have to do, whether it's a massive business or it's down at the just home level. Everybody's doing this right now. And so the things that I'm doing is I'm going to be educating people more. I'm going to be putting more content on more. I'm going to try to bring all the information I can deliver to you to help you out. So if you guys have questions and comments, let me know. And really, how is this affecting you? Think about it. Just ask yourself that question and start thinking about how this is affecting you and others around you. Because like I said, we're psychologically, we're going to go into a recession before we go to one. We most likely have to go to one because we have to lower these prices. They're crazy. But the one thing I keep hearing is housing might be the best bet. It might be one of the best bets in this inflationary environment. So time will tell. As Monty and I do our monthly updates, we will be laser focused on that data. We will continue to interview great people on the podcast. Microeconomics will continue to reach out to guys like Logan on Housing Wire that studies housing. We're going to be interviewing a great person here at the end of this month. I'm super excited. That's one of the gurus of housing. I'm glad it's a little bit later, so we'll be further along, and maybe they're right. So we're going to bring you real-time data and keep studying data. So keep your head high, ear to the ground. Make sure you guys are following people. And look, if you have to sell your house, you have to refi, you have to do anything, just keep in mind. I know the rates suck. I know they're high. But historically, if you go back through charts, when things are up, things come down. Things are up, things come down. This is the charts of history. So go back to 2018 and look at rates, and they came back. Go back to 2008, rates came down. So in a recession environment, rates usually drop because we basically need to speed up the economy. Just like we did, you just saw rates drop that low. I don't think they'll be that low. So today, if you're locking in at 5% rate, hopefully in 12 to 18 months, you'll be refinancing out into your rate a point and a half lower. I cannot guarantee it. If I could guarantee it, I would just write a book that you're guaranteed this, and then you'd never see me again. And I'd sell it to everybody. But until then, if you have questions, comments, if I can help you at all with anything in real estate, if you have any questions, feel free to reach out. My information is on this. Thanks for listening to my inflation rant, but hopefully this gives you some insight to everything I went through with data, housing, what other people are saying, what's out there. As I gather more and more information, I will deliver to you probably in shorter videos, more compact. But my name again is Kenny Simpson with the Simpson team, and I'm out.